All right, let's dive right into this explainer. Today, we're putting on our expert investment analyst hats and running UMH properties through what I like to call the ultimate valuation gauntlet. We aren't just going to skim the surface numbers here. No, we're going to apply the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, right alongside some pretty rigorous quantitative models. Let's dissect this stock.
Here is our roadmap for today. We'll start with a quick UMH company snapshot, look through the Buffett and Lynch lenses, run the Graham defensive checklist, build out a discounted cash flow valuation, test some alternative models, and finally wrap it up with our synthesis and verdict.
Section 1. MH Company Snapshot. Let's look at the foundational business.
So, UMH Properties, trading under the ticker UMH. They are a real estate investment trust, or REIT, and they've actually been operating since 1968. They own and manage 145 manufactured home communities across a bunch of different states. We are talking about over 27,000 developed home sites. You know, this isn't some speculative tech startup. This is a highly tangible, real-world business built purely on land, homes, and rent collection.
Pulling the raw figures from their Q1 2026 data, let's establish our baseline. UMH has an equity market capitalization of $1.22 billion. If we divide that by their 84.9 million basic shares, we can reverse engineer an implied share price of roughly $14.45. They pulled in $65.8 million in Q1 income, they're carrying about $759.8 million in debt, and, this is definitely the kicker if you're an income investor, they currently boast a massive 6.01% dividend yield.
Section 2. The Buffett and Lynch lenses. Time for the qualitative frameworks.
This is where it gets fun. We are contrasting two totally different legendary investing philosophies. Warren Buffett, as we know, is always hunting for impenetrable economic moats, highly consistent owner earnings, and honest management. Peter Lynch, on the other hand, categorizes the company first, like is it a fast grower, a stalwart, and then he ruthlessly evaluates the exact price he's paying for that specific growth.
Applying the Buffett lens first, UMH actually checks some pretty critical boxes. Do they have an economic moat? I'd say it's high. They provide cost-effective housing, which is huge in an inflationary environment, and the switching costs to actually pick up and move a manufactured home are incredibly prohibitive. Their earnings are also very consistent, with total revenue jumping 58% over the last 5 years. And, okay, while $759 million in debt might sound a little steep at first glance, an absolutely staggering 99.3% of it is fixed rate. Finding that level of protection from interest rate shocks, that is a massive positive surprise.
Now, Buffett famously focuses on owner earnings, right? The true, actual cash a business generates. But for a real estate company, traditional net income gets heavily skewed by those massive non-cash depreciation charges. So we have to make an analytical adjustment here. We use normalized funds from operations, or FFO, as our proxy. Taking their Q1 2026 normalized FFO of $19.35 million and annualizing it, we get approximately $77.4 million in solid cash-equivalent owner earnings.
Switching gears to Peter Lynch. Under his framework, UMH is a classic stalwart. It's a large, steady company that really doubles as a high-yield asset play. But remember, Lynch is super strict on price. UMH's price-to-FFO ratio is currently 15.7. If we divide that by their historical growth rate of about 6%, we end up with a PEG ratio of roughly 2.6. Since Lynch generally prefers a PEG of 1.0 or lower, this basically tells us you are paying a bit of a premium for that steady growth. However, given their incredibly stable management, CEO Samuel Landy has been there forever, and a really well-laddered debt profile stretching out to 2030, that premium might actually be justified for the right portfolio.
Section 3. The Graham defensive checklist and that all-important margin of safety.
Ben Graham's defensive investors checklist is notoriously brutal to pass, but UMH is shockingly resilient here. Adequate size? Yep, it easily clears the hurdle with a $1.2 billion market cap. Strong financial condition? That fixed-rate debt profile absolutely passes. Earnings stability? Net operating income is steadily growing. But guys, the absolute crown jewel here is the dividend record. UMH has paid out a continuous dividend for 34 straight years. Seeing a mobile home REIT with completely uninterrupted dividends for over 3 decades, that is genuinely incredible. It's exactly the kind of bulletproof stability Graham obsessed over.
To calculate Graham's actual intrinsic value, we use his classic formula, the square root of 22.5 times earnings per share times book value per share. But again, we have to adapt this for the REIT sector. We're substituting standard EPS with our annualized normalized FFO of roughly 92 cents per share, simply because real estate depreciation artificially tanks standard earnings.
So let's do the math. Plugging in that 92 cents in FFO per share and our 1445 book value proxy into Graham's formula, we get an intrinsic value of $17.29. When you compare that to our estimated current price of $14.45, that gives a strict value investor a very comfortable 16.4% margin of safety. Not bad at all.
Section 4, Discounted Cash Flow Valuation. Let's project those hard cash flows.
All right, building out our base case DCF. We are using that $77.4 million annualized FFO as our base free cash flow proxy. Now, to be super conservative, instead of using their historical high growth, we're just going to forecast out 5 years assuming a standard 4% industry average growth rate. That takes us from $77.4 million in year 1, steadily up to $90.5 million by year 5.
Then, we calculate the terminal value using a 2% perpetual growth rate, and we discount the whole thing back using a 7% weighted average cost of capital, which appropriately factors in their incredibly cheap 4.92% debt interest rate. When we run these assumptions through our base case sensitivity analysis, we land right at a fair value of precisely $15.70 per share.
Section 5. Alternative Valuation Models. Time for some REIT-specific tools.
Because of that massive 6.01% yield and that amazing 34-year track record we talked about, the dividend discount model is basically tailor-made for this analysis. The formula is beautifully simple. Expected dividend divided by the cost of equity minus the dividend growth rate. Taking their current trailing 12-month dividend of 90 cents, dividing it by an 8% cost of equity minus a highly conservative 2% long-term growth rate, we arrive at an implied fair value of exactly $15 per share.
And lastly, let's look at comparable multiples. UMH is currently trading at a price-to-FFO multiple of 15.7x. Now, the broader manufactured housing and residential REIT industry average typically hovers somewhere between 14x and 16x. This tells us UMH is trading right at the higher end of its peer group, which implies a relative fair value closer to the $14 mark.
Section 6. Final Synthesis and Verdict. Let's make the final investment call.
Okay, let's put it all together. Graham gave us a highly optimistic $17.29. Our DCF landed right at $15.70. The dividend discount model gave us an even $15, and market multiples pulled it down slightly to roughly $14. Averaging these 4 completely distinct outputs, we arrive at a synthesized fair value for UMH properties of exactly $15.50 per share.
So what's the final verdict? At the current estimated price of $14.45, UMH sits just below our $15.50 fair value. Honestly, this makes it a solid hold, or maybe a weak buy, specifically if you are a yield-hungry investor prioritizing that 6% income stream. The strengths are undeniable. You have incredible dividend consistency and a really proven ability to increase property values over time. But the risks are there too. Primarily that $759 million debt load and a slightly high PEG ratio for what is ultimately a slow-growing stalwart. To truly satisfy strict value gurus like Buffett and Graham, who usually demand a massive 30% margin of safety, they would probably sit on their hands right now and wait for a dip closer to $12 to trigger an aggressive buy.
So I'll leave you with this final thought to chew on for your own portfolio strategy. When you look at a highly tangible, stalwart asset like UMH Properties, does a totally guaranteed 34-year track record of a 6% yield compensate for slower capital appreciation? That is the ultimate question you have to answer as a defensive investor. Thanks for joining me on this deep dive. Keep running those numbers, and I'll catch you in the next explainer.